Comprehensive analysis of MiFID rules on payment for order flow, also known as PFOF. Chapter 1. Introduction to the MiFID PFOF ban. The upcoming MiFID rules that prohibit payment for order flow will come into effect across Europe in 2026. PFOF has been a controversial practice where market makers provide compensation to brokers for executing retail order flow, which raises several concerns about potential conflicts of interest, inferior execution quality, and decreased market transparency. Regulatory bodies are aiming to eradicate PFOF to foster fairness in financial markets and better trading outcomes, especially for small investors. Chapter 2. Emerging structures and concerns. In light of the impending PFOF ban, certain firms in Germany are establishing tightly knit structures that link single market maker venues with affiliated brokers. These new arrangements potentially create environments with even fewer competitive alternatives for retail order flow. The introduction of retail-focused exchanges run by brokers affiliated with single market makers may limit choice and transparency in execution, without scope for improvements that regulators sought to achieve. Chapter 3. Market practices and regulatory outlook. Observations of recent market practices indicate concerning trends. For instance, a prominent retail broker has created an exchange with limited market makers, one of which is affiliated with the broker itself. Additionally, other instances involve brokers directing orders to preferred venues that provide competitive advantages to specific market makers, compromising execution quality. Although the ban was targeted at strict PFOF practices, it may inadvertently allow affiliated market makers to benefit preferentially during order executions, ultimately leading to worse outcomes for retail investors. Chapter 4. Implications and questions raised. While the regulation aims for improved investor protection, the practical realities highlight potential loopholes that may negate the intended benefits. As affiliated market makers secure even better conditions for trade execution without the constraints of PFOF, the question looms: does this truly enhance investor outcomes, or does it deepen the reliance on non-competitive practices? Impact analysis. The changes from the MiFID PFOF ban will significantly affect various participants in financial markets. Financial institutions will need to revise their trading strategies and relationships with brokers to adapt to the new execution landscape. The inability to engage in PFOF shifts the balance in broker compensation structures and might necessitate enhanced transparency and reporting protocols to continue fostering trust and compliance. Financial intermediaries might face challenges if their primary revenue stream had included PFOF arrangements. They will need to innovate their service offerings and ensure competitive integration with alternate venues to mitigate the risk of diminished commissions and lost client trust. MiFID investment firms must adapt to the changes by ensuring compliance with the new guidelines, while also addressing any inherent conflicts created by exclusive partnerships with affiliated market makers, so that best execution is not compromised. Policy and procedure changes. Entities must update policies and practices related to order routing and execution quality, ensuring that they now comply with MiFID obligations regarding transparency and non-preferential treatment in trade execution.